Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, May 1st. Sentiment is improved despite a set of mixed economic data yesterday and thanks to stronger than expected big technology results yesterday after the bell. So as earnings continue to flow in, investors wonder if it's time or too early to jump back in. So we will talk about all that in this episode. But before we do, keep in mind that opinions that I will be sharing here are my own and this is not financial advice. So market sentiment improved yesterday following a deluge of economic data and earnings announcements on both sides of the Atlantic Ocean. In Europe, CPI updates from the major Eurozone economies came in stronger than expected by analysts, and the latter strength in CPI numbers certainly raised a few questions regarding the European Central Bank's ability or the immediate need to keep cutting the interest rates in the Eurozone. Because the Eurozone economy grew 0.4% in the first quarter of this year, that's dim compared to the US growth figures of last year, for example, but it's twice as faster than expected. And combined with the Eurozone countries' pledge to spend big amounts of money on defense and security in the coming months will suggest that a part of growth loss in the Eurozone due to the tariff war could be counterweighted by higher government spending. Now, note that growing by government spending only is not ideal in the medium to long run, but the latter could be behind the GDP data, the GDP beat that we saw yesterday in the Eurozone numbers. In all cases, the Eurodollar's decline, despite stronger than expected inflation and growth numbers, makes sense if we argue that falling inflation and dovish European Central Bank expectations were, the major drivers of the Euro's rally against the US dollar so far this year, but the diverging growth outlook between the US and the Eurozone, though it's mostly priced in, should eventually limit the downside correction in the Eurodollar. As such, the price pullbacks that we might see in the Eurodollar could be opportunities to strengthen long-year positions against the greenback. Minor support here is seen at 112.10 level, which is the minor 23.6% Fibonacci retracement on year-to-date rally, and the medium-term bullish trend will likely remain intact above the 110.25 mark, which is the major 38.2% Fibonacci retracement that should, in theory, distinguish between the actual positive trend in the Eurodollar from a bearish consolidation. Now, coming back to the diverging growth story between the United States and the Eurozone, the US GDP sharply fell in the first quarter of this year. Surprise! Because the US economy contracted 0.3% in the first quarter compared to a 2.4% advance a quarter before Donald Trump took office. Sales tumbled 2.5% from a positive 3.3% printed a quarter earlier, while a gauge of inflation, which is the core prices, jumped from 2.6 to 3.5%, which is also significantly above the 3.10% penciled in by analysts. ADP report, on the other hand, confirmed that jobs are being lost in the US and they are being lost faster than expected. So in summary, US economic growth contracted and inflation accelerated in the first quarter of this year. That is the worst possible combination of data, mind you. Not only could the US economy be heading into a recession, but stagflation. So high inflation and high unemployment might also be knocking on the door. That's why the S&P 500 initially tanked 2% after the release of the latest GDP data, alongside with an avalanche of cautious earnings statements and companies' reluctance to provide forecasts due to the highly uncertain trade environment. Happily though, the core PC data that was released just after the GDP data, and which is the Fed's favorite gauge of inflation, came in line for the yearly print and flat for the monthly number, and helped pouring some cold water on heated bears yesterday. So the S&P 500 finally rebounded to close the session 0.15% higher on hope that the Fed could eventually cut the interest rates sooner rather than later, and more rather than less, to provide some relief to the tariff-abated US economy. The question is, should the Federal Reserve act, knowing that inflation will likely spike in the coming months in the US due to the tariff jump in consumer prices. Donald Trump himself admitted that US children could have $2 instead of 30, and the two could cost a couple of bucks more, but how much more and for how long, more importantly, are the big questions that the Fed should be answering in the coming months. For now, though, the declining US 2-year yield suggests that part of the stock market rebound that we saw yesterday is driven by rising expectations of deeper Fed rate cuts this year. The 2-year yield actually briefly slipped below the 2.60% level yesterday, down sharply from near 4.40% at the start of this year. The US dollar index, on the other hand, recovered for the third straight session, but the Fed optimism is fragile, and it is probably increasingly at risk if inflation heats up in the coming months. In other central bank news, the Bank of Japan left its interest rates unchanged as widely expected today, but slashed its growth forecast for this year and for next year. At the same time, it released an updated CPI outlook of 1.9 to 2% for the next fiscal year, warning that inflation in Japan is likely to remain near target despite a slowing economy. So this means that rate hikes in Japan are still on the table for later this year. Now, investors surprisingly responded to the weaker GDP outlook by pushing the yen lower and lifting the Nikkei above its 50-day moving average. But perhaps they have kind of misinterpreted the numbers and certainly underestimated the hawkish risk. But let's enjoy the ride as it lasts, because futures are pointing at a positive start in the US and in Europe at the time I'm talking here this morning, as both Meta and Microsoft announced stronger than expected earnings, guys, after the bell yesterday. So Microsoft's cloud revenue grew by a third last quarter, confirming that the AI demand remains robust despite potential oversupply worries of the first quarter. So that's good news. Now note that Microsoft spent less last quarter for the first time in a long time, but that's happily not the plan elsewhere, because Meta, so Facebook's Meta, not only announced strong sales and strong advertisement revenue in the first quarter of this year thanks to AI, but the company also announced to raise this year's spending plans from 60 to 65 billion US dollars to 64 to 72 billion US dollars. So that's exactly what AI investors wanted to hear. Both Meta and Microsoft jumped in the after hours of trading around 5.30 to 7% respectively, and Apple and Amazon will be going to the earnings confessional today after the bell, and they will be telling investors how they plan to navigate the US tariff environment. Now, Apple already announced that it wants to move production away from China to India and some into the US. Donald Trump, on the other hand, rolled back his plans to tax smartphones, on warning that US-made iPhones could actually cost up to $3,000 per phone. But the company, so Apple, is obviously one of the most tariff-exposed big technology companies out there due to its complex international supply chain and its lagging AI progress. Amazon, on the other hand, which is obviously another highly tariff-concerned big technology company in the US, will likely see its e-commerce revenue take a certain hit from the US tariffs. Morgan Stanley analysts estimate that 18% of products on Amazon are imported from China, and roughly 60% of third-party sellers on the platform have some China exposure that could affect advertisement spending plans. That's bad news. But the company has jokers in hand, mind you. First, it has a cloud revenue to compete in promising AI, and robots are very much promising for the company. And second, Amazon just launched 27 Kuiper satellites to provide a Starlink-like internet connection to its consumers and its corporate clients. So price-wise, Amazon is just sitting on its long-term price trend, and strong earnings from the company today could eventually bring buyers in despite uncertain economic and trade environment. So this is all for today. I'm Ipek Ozkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe, of course, to our YouTube channel for daily market comments if you haven't done so far. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.